Video discusses how to use the calculator I built for the Delta Pilot's GVUL insurance policy. And we'll go into some of the bigger picture takeaways from the calculator. First, we got to start with, on the left here, the things in yellow are basically your user control panel, the inputs you get to make, your assumptions and parameters. The expected investment return is what you think the stock market overall is going to return over the period of your investments. This is an average value. In the very long run, that number is 10 to 11%. And if you want to account for things like inflation or pessimism, you can decrease this number. But as long as it's the same for both scenarios, it's useful because what we're doing is comparing the GVUL to the performance of a regular brokerage account. So this 1% gets used for both of those scenarios. So in a way, it doesn't matter what you put. What you put will change at what point you break even, but you can use whatever you want. The effective tax rate is individual to you. It's based on a guess. It's what you think your overall tax rate will be for this period. It'll change from year to year as you start making more money. But remember, we have a tiered tax system in the US, so you may be in the 37% bracket, the highest bracket, but only a small portion of your money will be getting taxed at that rate. Most of it will be getting taxed in the lower brackets. And so your effective tax rate will be lower than 37%, even if you reach into that bracket. This number is important because we base some assumptions on it that you'll see shortly. So try to pick your best guess on this. The next one is the investment front load. This is the 2.25% that MetLife charges on every dollar that you put in to your investment account with them. It gets taken off the front and you never see it again. Okay, next up, we have what I call the investment fund fees, also known as the expense ratio. You'll note that for the options in the GVUL, these are very high for our industry. Here's the prospectus for the GVUL plan, and this shows the 20 portfolios available to you under the plan. You can see the expense ratios here. The cheapest one is on the back here at 0.26%, and the most expensive one is up on the front here at 0.63%, I think. Compared to the rest of the industry, those are very high. Sorry, that's what we get. Unfortunately, we can't do any better yet. I think if we put pressure on our Alpha reps and we go to MetLife and insist on getting some better fund options in the GVUL, we can do it. But that's something we need to work on. Also for this calculator, there's a note here. You have to type the percent sign when you put in a value here. Otherwise, it'll give you errors. If you're getting a bunch of errors, that's quite possibly your problem. Next is the investment fees or expense ratio for what you would invest in a regular old brokerage account. For Fidelity, with their total market index fund, the expense ratio is 0.015%, 1/42nd of the most expensive expense ratio in the GVUL. Much lower fee, that's very important. Put in here what you think is realistic for the funds you invest in, but hopefully you're not investing with anything over 0.05% because frankly it's probably a waste. Next is the capital gains tax rate. This is either 0, 15, or 20 in the United States. Most pilots will probably be in the heart of the 15% range. As you get to be a more senior captain with lots of assets, you'll probably stray up toward that 20% range. So pick whichever one makes sense there. Next is annual principal invested. So this calculator assumes that you invest some principal every year into your investment side of your GVUL. You can put whatever value you want here as an average, but we're making it every year an investment. If you want to, you can play around with this and change it into a one-time kind of lump sum thing, or you can put periodic investments. You would just basically delete what's here and put in some new values where you want to. You can make it work if you know how to use a spreadsheet. Now, importantly, this column right here doesn't pull from this yellow value. It pulls from the white cell right below it because we have to account for this minus that 2.25% load. So if you put in 10 grand, right away MetLife is pulling off 225 bucks, and you got to account for that. Next is your birthday. Since we have a mandatory retirement age, I put it to calculate based on your birthday, to calculate when you turn 65, how many years you have left to show the full what you have left in your career as a possibility. You're welcome to change that around if you really want to, but I think that's a useful way to do it. Real quick, we'll go across the other tabs on the bottom here. You shouldn't need to use these a whole lot, but I'll show you what we're thinking. This is your premiums totalizer. This information right here on the right side is all provided by MetLife on the website directly for Delta pilots. They give the age ranges for premiums, and then they say what your taxable income difference will be based on Delta's premiums being counted as imputed income or not. Now note that some of Delta's premiums still count as imputed income and you'll still pay tax on those. Most of them do not. And so that's where they get this number. It's just a difference between the two. And then what we did is to get this assumed premiums, I divided the taxable income difference by the tax rate that you guess right here. Depending on your tax rate, these numbers will change quite a bit. That's the best we can do right now. For some reason, MetLife has chosen not to share with us the actual premiums for this plan, which is very frustrating. And hopefully we'll get that information at some point. Again, that's something to ask your ALPA reps. And then over here, we just show, again, the taxable income difference and the premiums paid year by year, adding it up. We show total premiums paid, and then taxable income saved by not paying imputed income tax, and we do the whole calculation on there. This other tab is your simple investment calculator. This is if you open a investment account at Vanguard or Fidelity or Robinhood or M1 Finance or wherever else, and you just invest your money. Notice you get your full $10,000 of principal every year because there isn't a front load at any other brokerage that I know of that I would actually use. It shows your investment earnings, how much capital gains tax you're going to pay on that, your total tax return on investment after taxes, and then it does it as a percentage, a raw percentage over the whole course of the investment, and then your effective annual return on investment in this column. Here we're going to look at just this top row to kind of explain what's going on. So based on your birthday, we calculate in year one, that's the first year of this investment is your 43rd year. There's your principal after load like we talked about. And then based on whatever expected investment return you have, that's going to be your portfolio value at the end of the year. This blue column here is Delta's total premiums paid over the whole course of the thing. So for the first year, it's just that first year's premiums. And again, that's a assumed value based on the tax savings that MetLife quotes and the tax rate that you chose here. Then you've got your total front-end tax savings. This is pulled directly from that table that MetLife provides. And we calculate investment earnings in the green column here, which is just your portfolio value minus your principal invested. Next, we've got this non-exempt earnings column here in the middle shade of green. So really all that is showing, has your investment earnings exceeded the premiums paid by Delta? Until that's happened, all of your earnings are exempt from capital gains tax because the premiums step up your cost basis and exclude all of your earnings from taxes. That's great. In this example here, that happens through year 8, and then in year 9, you've made 42 grand, whereas Delta's only paid 39 grand in premiums. So now there's about $3,000 of earnings that are not exempt from taxes if you were to pull it out right there at that point. And based on your capital gains tax rate, in this case, we chose 20%. Your capital gains tax, if you pulled all that out right there, would be $598. This next light blue column just shows unused premiums. So up until the point where your investment earnings exceed the premiums paid by Delta, there's some potential that you haven't used yet there in those premiums that Delta's paid. So this kind of accounts for that. Next, we've got this purple column for total back-end tax savings. So what that says either is if your investment earnings are less than your premiums paid, okay, so all these investment earnings are exempted from taxes, and so that's your savings. If they exceed it, then your back-end tax savings are based on what is exempt, which is up to the value that Delta's put in, and it's in this column here. If you look at the formulas for a couple minutes, it'll make more sense. Then I've got this column here. This is your total return on investment, including all the tax assumptions. So the front end savings on imputed income, the back end savings where deltas, premiums reduce or step up your cost basis and exempt more of your earnings from taxes. And then we get an effective return on investment, total over the course of the investment, and then an effective annual investment by just dividing your total ROI by the number of years that your money's been in the plan. Then to compare, this pulls directly from this simple investment calculator tab. So this is if you'd invested the same amount of money, the same 10 grand per year into a brokerage account, your total after-tax return would be your ROI and your effective annual ROI, again dividing by the number of years. Then this next column picks the winner. It says, is your return bigger in the GVUL with the tax advantages, or is it bigger in the regular brokerage account by having lower fees? And it shows the margin. This 11.15 is this 19.1 minus this 8.0%. So you can see for this example, for someone born this month in 1980, the GVUL wins in every case until retirement. And even the year you retire, GVUL is still doing 2.17% better than a regular brokerage account, even with all the fees and everything. That's pretty impressive. We'll get into some more of that in a minute. Real quick, let's take a look at this total premiums paid column. As you get older, the annual premiums get larger and larger. And if you see down here, for someone born born in 1980, Delta is going to pay $257,000 in premiums over the course of the rest of their career if they participate in the GVUL, and that's just a assumed number, a WAG based on the limited data we have. But that's a lot of money. That's a lot of earning potential for your investments that you could take advantage of, which is kind of nice. So let's look at some other situations. Let's start by looking at a young pup. Somebody born in 2000, they're 23 this year, just starting at Delta. We're all jealous of you. Well done. We come over here and we see GVUL wins all the way down until here, which is year 2021, the 20th or 21st year. The brokerage account starts winning. So at that point, the fees from the GVUL and the premiums getting used up kind of eliminate the advantage there, and the advantage starts going to the brokerage account. So if you are brand new at Delta and you're 23 years old and you're planning to keep your money in this plan until 42 years from now, the brokerage account is going to be better by about 3.5%. There you go. That's one scenario. Let's look at a scenario of a pilot that's much closer to retirement. Let's look at somebody born in 1960. They only got about 3 years to retirement. Congratulations. Look at this. Delta's still going to pay $63,000, almost $64,000 in premiums on their behalf before they retire. We go through here, and if you only put in 10 grand per year with all these other assumptions, you're going to end up with 60 grand in unused premiums. So your investment earnings aren't particularly high. It'll be $3,000, but there's still a lot of unused premiums. Now, that said, look at these returns on investment. Because of the tax advantages and how much Delta is paying in premiums, your first year ROI is 64%. That's huge. That's enormous. And even after 3 years, a 23% ROI is just mind-boggling. Under the same assumptions, your brokerage account scenario would only get a 3.8% average return on investment. So obviously the GVUL just blows it out of the water here. That's really impressive. Now you've got all these unused premiums, right? So what if we adjusted to try to use up some of those? There's 60,000 in unused premiums. Let's try to put 50,000 a year into this plan. As we go through that, you still end up with 44,000 in unused premiums. So it didn't really even make a dent in those unused premiums. Now your effective annual return on investment did decrease in the GVUL, but it's still significantly better than what you get in a regular brokerage account. We can take this all the way up, I think, $150,000 a year. Even if you put that much in, you're still going to have unused premiums because your investment earnings on 150 grand a year, so a total of $450,000 invested, you're going to earn upwards of $58,000 over the next 3 years. And there's still going to be $5,000 in unused premiums from Delta, which, fine, that's money on the table, but it's okay. GVUL still wins by almost 3% in the last year. Your effective annual ROI goes down, but that's a lot of earnings. That's almost 60,000 in earnings that are not going to get taxed on the back end, and it's $60,000 of imputed income that won't get taxed on the front end. That's a lot of savings right there. Let's take this back down a little bit, 10,000, and let's look at somebody who's maybe a little bit younger, 1970. You can see it goes on for a few more years. At only 10 grand a year, they're leaving 100 grand on the table of unused premiums. That's okay. You're not necessarily losing a whole lot there. Again, if you look at the numbers, even with all the fees in the GVUL, you're still doing far better in this scenario than you would in the brokerage account. And you're 5% better in the GVUL. Now we could up that here. You're putting 50 grand a year in. Now all of a sudden you've used up your premiums, which is kind of nice for your investment returns. And we're looking at over the course of 13 years, you'll have put in 600 grand, and it's projecting a total of 500 grand in investment earnings. Average annual return on investment by the time you retire of 6.7%. That's still more than 1% better in the GVUL than it would be in a regular brokerage account. Let's go back to maybe oops, don't change the date in there. Click on it and then go up to this line to change it. Let's go back to maybe a younger pilot. 50,000 a year is probably a lot. Yeah, they're gonna, well, that's valuable. Now let's make it a little lower. Okay. Yeah. Trying to make a point here. So, born in 1990, all those other assumptions stayed the same. You're putting 15 grand a year into your investments. Over the course of it all, by the end of your career, you'll have invested $480,000 after MetLife takes their cut. Delta will have put in $288,000 in premiums. Your investment earnings are enormous. Lots of, you're way beyond premiums paid in there. They're just counting for a little bit of it. But when we come back here, we see GVUL wins by quite a bit, and then it tapers off. And kind of in this middle zone, really in my mind, this doesn't matter. If you're less than 1% difference between the GVUL and the brokerage account, who cares, right? Maybe as time goes on, getting down here, maybe a little over 1%, it's worth it if you're planning to leave your money in there for 33 years until age 65. Otherwise, it's kind of a break-even scenario. But there is a clearly defined point at which on your years 18 and 19 here where it switches over from one being advantageous to the other. The other checkpoint you could be using to look for is you just want to use up all of Delta's premiums. You want to get that money off the table, and instead of having that money just get handed to MetLife and you never see it again, you get it back as tax deduction against your earnings. So here at the end of year 4 into year 5, that's kind of where those premiums get used up. So you can put your money in, 15 grand a year for 4 years, let it ride, and then pull it out at the end of the 4th year. You'd be using up all those premiums. And then at that point, you jump back into a calculator just like this and run the numbers again. And it might be worth starting to invest back into your GVUL and pull out again at a certain point in time. If you change the amount of money you're investing, that point will shift, move down a little bit here, or if you're investing more, at that point, you're going to use up all the premiums right away and you're going to stay ahead of that because you're just investing $30,000 so much per year. And then you see it also changes the point at which you break even, and toward the end, the brokerage starts to make a little bit more sense. I mentioned this in the article, but I'll say it again. Please don't make your decision, your final decision, just based on looking at this calculator. Throw some numbers in this calculator. Try to make your assumptions realistic to what you would do and what you expect as far as investment returns and tax rates and things. Then when you get a scenario that you think is realistic, take that to your tax pro, to your financial advisor, and ask them what they think. And have a discussion. And let this calculator be what starts the discussion, but let the discussion end with some professional financial advice. But I hope this helps. Remember, don't ask permission to edit my copy of this calculator. I won't give them to you. Instead, you should be prompted to save your own copy, and if you aren't, just use File, Make a Copy, or File, Download, and you can download it as Excel or whatever other format you want. But if you got any questions on it, how to work it, or just general big picture idea type stuff, please reach out to me. I'm happy to help. I am not a tax pro. This is not tax or finance advice. I'm not an investing pro. But if you need help figuring out how to use the calculator or big picture ideas, I'm happy to help with that. Thanks, and good luck.